Good morning. So thank you for this opportunity just to talk on what Labour's policy will effectively mean, or some analysis of what this means for carbon markets. Now, I'll first start by saying it is complicated, right? There's a lot of uncertainty in terms of how this policy will be implemented. And so we'll step through some of the key assumptions. Now, before I start, the first thing to note is this policy was effectively written in December 2021. Now, in 6 months, we have seen an extraordinary change in energy markets. So keep that in mind, because it really does underpin some of the assumptions and where some of the risks have now evolved. And this is where we could potentially see the carbon market play a much bigger role than what was initially expected, even with the initial modeling. So with that, if I can get started. So look, I'll start by just comparing what was initially announced by the government in the end of 2021 in terms of the modeling for what they were expecting the reductions of the Australian economy. Now, the coalition was initially targeting 26 to 28%, but what the modeling showed is we were going to get to 30% pretty much as the status quo. You know, this was going to happen regardless of government plans. Now, there was, a scenario there where if technology was adopted, the coalition was forecasting we could get to 35% reduction in 2030 relative to 2005. And that was probably the high point of where the coalition ambitions were. Now, what we see is when we talk about what the Labour government is looking to target, we're talking 43%. So there is a significant leap now from that 35% that needs to be hit by 2030. Now, it is in this environment where we now get into the nuts and bolts of what is actually required to get there. And that modeling you can really see now in this chart here on the right. And the way they've broken it up, and this is from the ALP itself in terms of what their forecast is you can see that cumulatively they're talking about 440 million tons of carbon emissions that have to be cut, right? That's from 2023 to 2030. And you can see from there the sectors which are really going to do the heavy lifting. One is the electricity sector, and then the transport sector really jumps on top of that with the EV story. And then you have this massive safeguard mechanism, which is going to play a big role. And then finally, and this is something that got introduced after this modeling was done, was what is going to happen with a component of ACCU supply. And we call that fixed carbon abatement contracts, or fixed CACs for short. And so all this is now playing out and have enormous implications for how the carbon market will develop. So I guess I'll start with the electricity sector. And just to kind of get a grasp of just how ambitious the target is the expectation from the Labour government is that we'll go from roughly 35% renewable penetration today to about 82% by 2030, right? Now, the reason why this is something that they've noted is this is something that the AEMO, which is the Australian Energy Market Operator, has also assumed as their base case at the end of last year, right? So to understand just the gravity of change that's happened in the electricity sector, the economics of renewables has lifted to such an extent relative to fossil fuels that we're seeing this investment towards renewable penetration become quite significant. Now, there are risks, and plenty of risks, which we'll talk to about this ambition. But just to put it all out there, is that part of this is record renewable deployment, but also the retirement of coal. And it's the combination of both which is really going to mean how much of this penetration that we see in terms of the renewable share of total grid generation, right? Now, you can see there that under the coalition modeling that it was something a little less, 68%, that would have been the status quo. But that extra 12% we're talking about when we say, okay, this is where the Labour government is aiming for, it requires an extraordinary amount of work in terms of what needs to be built in the next 7 years. Now, first and foremost, it's going to be coal retirements. If you remember early this year, one of the biggest announcements was a coal generator here in New South Wales, Hunter, the Eraring, pushing forward their retirement from 2032 to 2025. Now, before that was even announced, AEMO had said that if you really want to get to this level of 80% penetration, you need a record pace of renewable deployment every year until 2030. So by that, you need perfect supply chain management, right? And the one thing we do know is that has proven to be extraordinarily difficult, right? Now, on top of that, we have earlier coal retirements, which wasn't modeled, right? And this is where, for instance, if you want to get in front of Eraring and build the renewables necessary, we're talking almost 2 to 3 times the pace of record renewables on the grid in the next few years, right? So there's enormous risk here in terms of power market just having enough power gen to meet demand if these coal retirements go ahead as planned. And this is where there's enormous risk to, I guess, the electricity sector, but even importantly, how we decarbonize and are we going to build in front of these retirements. So if we go to, I guess, the next chart, here you just get an idea of just the level and the pace of renewable deployment that's needed. And I guess what I want to stress in all this is just have a look at the curves there on the right. We're talking very rapid changes quite quickly. The red line on the chart on the right is what is base case now, right? And 2 years ago, this was considered the step change scenario. This has now become the base case scenario. So the market has had to adjust to very, very significant changes very quickly. And it is this world that we walk into where we have enormous concerns that this idea of 80% renewables by 2030 is under risk because we just don't have the supply chains. We've already heard that solar and wind deployments have been delayed, right, particularly out of China. Transmission has proven to be one of the biggest constraints. And part of the Labour policy is spending about 20 billion to almost bring forward a lot of the transmission. Now, if they manage that, that would be great and enable a lot more renewable penetration. But what we have seen is that there is enormous and onerous regulatory hurdles in getting some of these transmission assets up and running. A good example is Energy Connect, which connects South Australia to New South Wales and even Victoria. And that just broke ground this year, even though it had been given accelerated treatment in the regulatory testing. So it is very challenging to get transmission right. And Labour has a very ambitious policy over the next 5 years. But the risk is that we don't see enough transmission and we don't see enough renewables. Now, putting that together, you can see the risk here that we may not have a grid that is as decarbonized as we are hoping for. And the last 6 months have really accentuated that risk. So I guess the next aspect to talk about is transport. Now, this plays a much smaller role compared to the electricity sector, but it really piggybacks and is the real talking point when we say, okay, the electrification of the economy, this is the sector which is talked about the most. Now, the question of what's the point of EVs if our grid has such a high penetration of say, coal power? And the first thing I'd say is that it is still net on net much better to go EVs, even if your grid is 65% coal powered, than it is to just be like, oh, I'll just use an internal combustion engine. And that chart there on the left really shows you that if you're talking about the use of EVs versus internal combustion engines, we're talking about a 65% increase in emissions for use when you're using a petrol car, even with a grid which is 65% coal. So, this movement towards EVs is going to happen, right? And it's still going to be beneficial. But of course, if you can do it with solar, that is going to be the most critical part of how we manage this transition and how do we reduce emissions. And this is something that's certainly possible. 1 in 3 households in Australia have rooftop solar. And that is something which is going to enable a lot of the electrification in a green way, right? Particularly when we talk about EVs. So that is certainly something that is developing. But I guess, once again, the issue of electrifying is that we need to make sure there's enough generation. And if you look at what the Labour policy is, about 3.8 million EVs by 2030, you're really talking almost a 4 to 4.5% increase in generation needed by 2030, right? So once again, it's like, will we build in front of that? And this is where the constant risk is that electrification is going to be the lowest cost, but do we have the supply chains and the transmission to make it happen? And this is the challenge we're facing going forward. And that table there on the right, that's from the IEA, it tells you different countries and kind of the demand increase that we're going to see from the EV sector, and it's what it will draw in terms of electricity generation. And Australia is very much in that bucket given the Labour policy. The one big draw card, though, that is working towards EVs, particularly post-Ukraine conflict, is the economics, right? Now, the key part here is we have seen EV costs rise. Lithium product prices are 8 to 9 times higher than they were just 1 year ago, right? And that's a key component when we talk about EV raw materials. But despite the increases we've seen in pricing, battery pack costs are expected to rise about 15%, and potentially, say, on the high side, 25% if we get there. Now, that is still relatively much less than the increase in costs we've seen from the increase in petrol and diesel prices. Now, that chart on the right, people pay a lot of attention to oil, but that has not been the only story when we talk about what's happened in the transport sector. Oil prices have increased, and it's been in the magnitude of 50% increase from the start of the year. But diesel and petrol have jumped even higher. We've seen global refining capacity go backwards last year, and Russia accounts for about 6.5% of global diesel supply. So the fact of the matter is, no matter how you cut it, relatively, EVs are more attractive than internal combustion engines. But this is something just to watch, because in our view, even though you have the economics supporting it, do we have the electricity infrastructure for it? And the risk is that if we don't see the grid decarbonize quickly enough, will you get the same gains that are expected in the modeling when EVs are deployed by the end of this decade? And those are the key risks when we talk about how does this now all factor into what the carbon market needs to achieve for the Labour policy to be met. So I guess I'll start with the safeguard mechanism. Now, this is where there is complexity in terms of how this will happen, right? First of all, there are two parts that need to be considered. One is, where does the Labour government set the baselines for the safeguard facilities? There are about 215, as we heard. And when you talk about what you would want, ideally, you want your baselines to be cutting when they're established by 2023 and implemented. Now, this is something that we don't know, right? This is going to depend on Labour policy, the clean energy regulator, and conversations with different clients. We don't know this, but our assumption here is that if you manage to make that safeguard mechanism biting from day one, right? And the plan is that you reduce the baseline by 5 million tons every year. And that is all that we can actually accumulate over the next, from 2023 to 2030. We're actually talking about 180 million tons of accumulated carbon reduction from the safeguard mechanism. Now, there are estimates out there which say that's too high and would say that that should be lower than that. But if you achieve a baseline, in our view, this is the one part of the entire modeling which is controllable. Every other aspect that we're going to talk through apart from the safeguard mechanism is really out of the Labour Party's hands. This is economics that are going to define it, supply chains that are going to define it, but this aspect of it, the safeguard mechanism, is something that is at least the most controllable aspect, right? Now, the part that's connected to the safeguard mechanism is this new I guess, structure called the National Reconstruction Fund. Now, this is effectively what can low emissions technology achieve with government help? Now, we have given this portion of reduction a very small role, 33 million tons, right? And so that gives that safeguard mechanism of 213 from that first slide. But the reason why we've given this such a low allocation is that this is the riskiest part and the most uncontrollable part of this story. Like, this means, will we have a hydrogen sector that's developed or commercial? Will we have supply chains for CCS, carbon capture and storage, developed? And these questions are ultimately unknown from where we sit. And for us, we don't want to make a strenuous assumption that this part can be big. We'd rather upside risk here, and that's what we've kind of modeled, that yes, if it gives us something, maybe it can mitigate some of the risks we're seeing in the electricity and transport sector. But we shouldn't make the National Reconstruction Fund do more work than necessary, because it is inherently risky. Because low emission tech adoption is going to be challenging. And if you look at Japan and the feedback that we've heard from there, they're talking about low emission tech switches 2030 plus. So to say that we'll get there before then is very, very challenging. The other part to talk about, and a big change to the policy, is if we already know that if you miss your target, your baseline target, you have to buy accus to get back to your baseline, right? But the mechanism has also been enhanced that if you overachieve, you actually get what you call safeguard mechanism credits. Now, this is a different type of carbon credit, which is basically going to be traded amongst industrial entities or safeguard entities, right? And this is going to be a very different market, right? In that it's not going to be as, or has the same integrity as your accus or your Australian carbon credit units. So if you're going to design how this will work, you want to make sure your baselines are biting. Because if your safeguard mechanism credits just fill up and you have plenty of those, you actually undermine what is happening in the accu market. But more than that, you undermine the price signals to build new supply in the accu market. And that is going to be a big, big issue. So, in our view, you need the baselines to do most of the work. If you don't, then you undermine this market. And we'll go into why that's already such a big issue right now. Look, there's tables there, and I apologize that the numbers may look too small. But basically, this is a scenario of what the safeguard mechanism may have to do if you look at what the trade-exposed, emissions-intensive industries have to achieve. Now, they account for 59% of the safeguard mechanism or the safeguard emissions. And you can see there that if they do 20% of the work, what does that mean for the different sectors that are involved in, or for each safeguard facility? And I guess underpinning this scenario, you can see just looking at that chart there, that if you reduce the share of these trade-exposed emissions-intensive industries, your coal sector has to do an enormous amount of work to decarbonize. And the idea of this scenario is simply just to understand where the stress points are. Which industries are we going to see that will have to do more than their share, and how much will they have to do? So this is just one scenario which could develop. The other scenario that we've considered is a fossil fuel exposed scenario, right? Now, these account for about 52% of the safeguard emissions. But the question here is, we have abnormal profits for oil, gas, and coal. Now, what if they had to pay for it via carbon credits? And so this scenario is different. It hasn't been talked about, but it is certainly something that is worth looking into, given that in the UK, we're talking about an energy windfall tax, right? Is this something that we could see pseudo-implemented here via the safeguard mechanism? So this is another scenario which can look at what they do, but you can see here there's enormous variability depending on what we see the policy decisions from the Labour Party. And finally, I really wanted to talk about what's happening with a structural change in the market. Now, the ACCU market is really defined by two, I guess, client segments. One is the government, and the other was the voluntary market. Now, the government was the major buyer, but we saw a massive shift in that what was contracted to the government in terms of fixed carbon abatement contracts are now effectively going to be available in the voluntary market. Now, this is the big reason why we saw prices fall at the beginning of this year, and why we saw prices, track under $30 a ton just a few weeks ago. Now, if you look at the details of that policy, the floor price implied by that is about $24 a ton, right? But the 110 potential ACCUs which are combined in this, and that have to be, that could effectively be deployed in the voluntary market, really does mean that the ACCU spot price is going to be subdued for a while yet. To put into perspective why that chart on the right is so significant, annual supply of ACCUs is about 16 to 17 million tons. That chart there on the right gives you a schedule of all the ACCUs that are going to come from what was originally going to go to the government and are now going to be sold potentially to the voluntary market. And you can see that it will swamp, and cause an oversupply. And so this is now another factor that you have to consider. Now, the reason why this is critical to Labour policy is if the government had bought it, it would have been surrendered and it would have been part of the NDC, the 43% emissions reduction. But if this 110 million tons are swept up by the voluntary market, it doesn't actually contribute as yet, according to current policy, to our 43% reduction commitment. So who will buy this? And this for us is the biggest risk to consider when we consider what is going to happen in the future. Will we see Labour walk back this policy that the coalition implemented? Will we see the government step in, state governments step in? This is now where it gets very uncertain because we need to find a way to address this 110 million tons. So if I could just sum up all those factors, that chart there on the right for me is telling that electricity and transport over the last 6 months, based on the modeling, it looks like they'll underperform. The way that we've kind of split Safeguard and the National Reconstruction Fund means that there's probably upside risks to what the National Reconstruction Fund can do, and where we like those balance of risks. But what is in your control is the Safeguard mechanism, and we need that to be very biting in order for the ACCU market to be as supported as possible. But ultimately, the question is, what do we do with this fixed CAC problem? Because at the end of the day, it is that 110 million tons. If we don't address that, it's going to be quite a battle to actually get to the 43% reduction the government is aiming for. So expect policy to change this year, expect policy to be announced. And this is the environment we're in. But these are the key factors to consider. And this is really, I guess, our key conclusions from what's been announced by Labour.